Welcome to Every Dollar Counts with Josh and Jay, a weekly shot of true serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, Regional Director for First Protective. We are brought to you on the Prime Capital Investment Advisors Podcast Network. You're joining us on Chapter 2 of our Retirement Educational and Planning Series, or REAP series, thanks to Jay and his just big creative brain. A 4-part podcast series where we touch on really important elements that business owners, plan administrators, and participants need to consider. In this episode, we will discuss the 3 things that you should be thinking about with the target date funds that are typically found in your retirement plan, like your 401k or your 403b. Joining us in studio to discuss this is Chris Roper, Plan Success Consultant with Qualified Plan Advisors, and Chris Bouffard, Managing Director of Wealth Management for Prime Capital Investment Advisors. Now, for all you Bob Newhart fans, so this is my brother Chris, this is my other brother Chris, and thankfully they bring a bunch of wealth and knowledge and experience to these 401k, 403b retirement plan topics. Before we dive into all this, though, let's have our friends from Sloth Racer kick us off. Jay, how you doing?
Man, Josh, one more podcast sitting here at the table with you and these guys, my friend Chris and my other friend Chris. It's nice to be here. I've got a couple of questions I need to ask these guys.
Very good. Chris Roper.
Hey, how's it going?
Yeah, good. Chris Bouffard, who I was just informed that is a French background, right?
French Canadian.
Yeah,
yes.
so you fit in really well down here in Mobile, Alabama during Mardi Gras season. So welcome to the show. Thanks for joining us.
Happy to be here.
All right. I got to do a quick housekeeping for compliance, Jay, before you ask Chris your question. Jay Stubbs and First Protective are not affiliated with Prime Capital Investment Advisors or with Qualified Plan Advisors or with Gulf Coast Financial Advisors. And Chris Roper and Chris Bouffard are not affiliated with Gulf Coast Financial Advisors or First Protective. All right, Jay, the floor is yours.
Well, we're doing this REAP series for these business owners and decision makers out there, REAP being retirement, educational, and planning. You know, we've talked about some specifics on benchmarking. My question for Chris Roper, you know, I see these things, funds, and then I see these other things, target date funds. Very simply, what's the difference between those?
Sure, that's a great question that we get a lot. Really, if you can think about it 2 simple ways. You have a core fund lineup inside of most 401k plans, and in that's the funds you're talking about. So you might see a large cap value fund, you might see a small cap value, a bond fund. And what we call that is, to make it easy, is a do-it-myself strategy. So you're going to go in there and you're going to pick, I want 10% in this fund, 15% in that fund, to build yourself a diversified portfolio based on your risk, probably is how most people do it. There's a large portion of the population who doesn't really understand funds, doesn't want to understand funds, just needs some help. And really what those are, we have a couple different things, but one of them that we're talking about today is target date funds. And what target date fund does is, whatever provider that you have, whether it be American Funds or JP Morgan, BlackRock, Vanguard, whatever it is, they're going to go in and based on your age. So I'm 35, I just turned 35, and I'm going to retire at 60. Yeah, right? Yeah. The young guy in here. So I'm 35, so I would pick the fund that is closest to my retirement age. So that would be 2055 for me. Okay, that's when and what the fund is going to do, that target date fund, is it's going to start me out aggressive and get me a little more conservative as I reach towards retirement. So it puts me on that do-it-for-me path, and they do everything for you. You just pick the date that you.
So if I'm 50 years old and just getting into a company's 401k plan or just moved into it and a target date is such, I'm going to pick something that might have a target date different, that I would say 65 or 70. So I might have a target date that's going to fit my overall risk profile. Is that what's going to change with the target dates as I get older?
Yeah, and it won't be it's not based on your risk profile at all. It's just based specifically on the time you have to get from where you're at as your age until the retirement date, which for most target date funds is 65. So if you're 50 years old right now, you'd pick one that's 15 years out. So it'd be 2035 would be the fund. And it's going to, basically what they're going to do is they're going to pick an allocation for you today. And it's going to, every year, it'll ratchet down a little more conservative as you get closer to retirement.
I like to say that's the retirement red zone.
The retirement
Sometimes
red zone.
in that 3 to 5 years out from pulling that retirement trigger.
Well, Chris Bouffard, I got a question for you on that. So we're talking about target date funds in a general sense. And from what I'm hearing, it sounds like all target date funds are the same, but that's not accurate, right? What are the differences? So the first thing that an investor, plan administrator needs to understand about target date funds, there's different qualities of funds? There's different levels. How does it work? What's the breakdown on that?
Good observation, and it does sound like it's the same thing because everything's theoretically based on your target date. But good thing to remember is know what you own, and although these things, you could have two different target date fund families with the same target date and have different exposures. Meaning that they're a percent of equity, and therefore the volatility in market conditions will be different. So that's one thing to understand. Sometimes there's different asset classes in these target dates. Most of them, are prepackaged, diversified products, so they have different asset classes: U.S. growth funds, small cap value funds, international bonds. But sometimes there's certain target dates that have certain exposures to asset classes that others might not.
Well, okay, let me ask you in this way then. If you're telling me that if I've got, a target date usually has a number at the end of its description, target date 2050, 2035. Are you telling me that I could have two target dates, 2050, the year 2050, two different providers, and I potentially might have different performance and different risk tolerances as those play out?
That's exactly what I'm telling you, yes.
All right, very good. Chris Roper, back to you. Does that, with the quality of the funds and the holdings in there, how does the share classes relate to the funds and the target date funds? How does that play into all to this?
Yeah, so let's unpack share classes for a minute and just go back and let's give an example for the people out there so they kind of understand what a share class is, because this is kind of a hard concept for a lot of people to get, but it's a very important concept if you have money. No matter if you have money in a plan or not, it's a very important concept to understand. So let's just say that...
Well, okay, I'll jump in.
Yeah.
Important concept. Is it fair to say that generally speaking, for a large number of people, their retirement savings are typically wrapped up in a 401k, 403b, some type of retirement plan, right?
Yes.
Right. And is it fair to say, if that's the case, that more often than not, you're seeing a lot of target date funds, right?
Yes.
Right.
It's by far the fastest growing segment of money flowing into and in anywhere that we see, any asset class.
So, what we're saying is we're talking about potentially what is one of the largest type of fund holdings in most retirement accounts.
Correct.
Which just exaggerates the importance of understanding them.
Correct.
Okay.
Exactly. So when you talk about share classes, so let's dive into that real quick. So let's just say that Josh and Jay, they just start a fund company. They have target date funds, okay? And I'm going to invest in that, and I have $100,000 to invest in your fund. And
Mardi Gras beads.
Mardi Gras beads. Yes, that's the name of the fund. Mardi
Ethically
Gras beads.
farmed Mardi Gras beads.
Okay, perfect.
Is what we'll do.
So I'm going to put my $100,000 into this fund, and you guys are going to go buy ethically farmed Mardi Gras beads. That's perfect. Right. Well, then all of a sudden, Chris Bouffard comes over and he says, hey, I really like this idea for some reason, and I want to put $10 million into this fund. But I have way more money that I'm putting into this fund than Chris's $100,000. I don't want to pay the same fee that you're charging Chris. I want a less fee. I want half the fee that you're going to pay. Okay, so you're going to have the exact same fund buying ethically farmed Mardi Gras beads, but you're going to charge him less. So to do that, you need a different share class. That's where share class comes into play. So maybe I'm charged 1% fee for your guys' management of these ethically farmed beads.
Mardi Gras beads.
And Chris is only going to pay 0.5% because he has a lot more money. So this is where share classes come into play. And why is that important? Well, it's the exact same fund. We're buying the exact same thing. He's just paying a lower price. So if you take that example and you bring it over to the retirement plan space, would you rather be paying more for the same thing or less for it?
Be easy.
Less. You would pay less. So, and as a fiduciary, we talked about that in the last episode, as a fiduciary, it's your duty to get your participants and have your plan have the lowest cost share class available. And how do you go about doing that? There's negotiations, there's asking the questions, and there's really just knowing what's out there and how you should be doing those things. But you need to understand what share classes are available, what share classes you have, and can you get into a cheaper share class so you can, the less money that you're paying out to these fund companies, the more money that you're getting back in your pocketbook.
Absolutely.
Well, it just seems logical to think that when we go into any of the Walmarts or the Costcos of the world, we see large volumes and our price per unit comes down the more we get. So share classes is very much so a price per volume, if you want to think about it like that, or price per unit.
Exactly.
Okay. Easy to understand for this insurance guy over here.
Right. All right. So the first two things that folks need to think about with their target date funds, which we all agree is typically a fairly large component of their retirement plan, their qualified retirement plan. First was what you had listed as quality of funds, but really what we're referring to is the holdings inside those funds, and how even two target date funds that are labeled the same as a 2035 or 2040 or where it may have significantly different risk tolerances and equity holdings and things of that nature, right? Second thing was share classes and looking at where can you get really the most bang for your buck, by methodically looking through these things. The third thing is, Chris Bouffard, I'm going to kick it to you, is what do you think is the biggest liability facing target date funds or facing this discussion? And we have listed here TDF, so I'll kick it that way to you.
Well, one of the issues with target date funds is that by definition, your retirement age and your age, your retirement date and your age are determining your exposure to equities and therefore your risk tolerance. So that necessarily is not the situation for people, just like you may have two 2035 target date funds with different makeups and equity exposures and risk levels. You could have two investors that are the same age, same background, but wildly different willingness and ability to take on risk.
All the super young guys like Roper over here, they tell me that they're less risky than us old gray-haired Gen Xers. So I don't know if that plays a part in that or not.
By definition, the target date is making you more risky the younger you are. But there could be two, people's fitting the profile of Chris Roper at the same age and demographics and lifestyle, but just wildly different goals and or willingness and ability to take on risk. So that's one thing to keep in mind, that it might not be the sole determinant to make up. And that's why you also have core plan lineups. So some investors may choose, a different approach to use core plan lineups to, self-determine their own portfolio rather than the prepackaged target date.
Perfect. Chris Roper, you had listed on the show notes to versus through. What's that mean?
This is where we get into not all target date funds are created equally. They have what's called a glide path, which we kind of talked about. It starts out as aggressive. It gets more conservative over time. And if you think about that, if you could plot that on a graph, I know we're doing this over the radio, but you think about a curve going from the top left and it slides down over to the right is kind of how the slope goes. Well, different fund companies have different philosophies on investment. Okay. So I'll go ahead and throw out two to make really good examples of the two of them. T. Rowe Price, they're really good at equity manager, and magically they think that equities are really, really important for people. We don't need to get you just to retirement. We need to get you all the way through retirement. So what they do in their glide path is they keep you more aggressive, not up until the date you get to your retirement, which is the date that you're picking, but all the way through 30 years after. So that it doesn't get to the most conservative point in their portfolios until 30 years after the retirement date. So let's use me as an example again. I'm 35 right now. In 30 years, I'd be retiring. So in the next 30 to 60 years is when I'd be taking money. But in 60 years from today is when the point of that portfolio gets to its most conservative point.
Okay.
That's different from if you look at a manager like PIMCO, which is a famous bond manager, and they say, hey, we just need to get you to retirement. Okay, so they're going to get you at the point at which you hit that retirement date, your portfolio is the most conservative it's going to be. So there is a huge, huge problem with what we have going on in the industry with this specific point. Okay, it doesn't matter which philosophy that you believe in or which philosophy your plan has. The majority of people don't know what they have. And Chris Bouffard mentioned this earlier. When you have the structural limitations of 401ks, and let me explain that for just 1 second. So in 2006, the Pension Protection Act came out, and the federal government was saying, hey, we need to help people save more. And plan sponsors were said, hey, we need your help because we're afraid to automatically put people into plans because we're afraid we're going to get sued for putting them into something that they didn't pick. So the government said, hey, here's a federal safe harbor for what's called a QDIA, Qualified Default Investment Alternative, and target date funds are one of those. So then all of a sudden, if plan sponsors automatically enroll their people into this QDIA or a target date fund, then they would have a safe harbor and they can't get sued for that decision. So all of a sudden from 2006 on, we see a mass inflow of money going to target date funds. This is good for people. We're helping people out. This is fantastic. But what do we have on the other side of that is, okay, we have people going into plans. They're not picking their investments. They have no tie to this decision. Okay. They don't know what they own. and all of a sudden you have an '08 event, okay? And look at target date funds in the 2008 era, and let's see what happened. Well, a 2010 vintage target date fund, okay, which means I'm planning to retire in 2010. In 2008, depending on what you were looking at from the different target date fund providers. So again, going from that to versus through, a PIMCO versus to a price, you might have been down 4%, you might have been down over 40%.
Right.
So if you're 2 years out from retirement and you're all of a sudden your account's down 40%, what are you going to do? You're probably going to pull the trigger. You're probably going to sell. You're not going to recover. You're not going to be able to retire. What does that look like as an employee? Do you have a happy employee?
No.
No, not at all. So it's just a terrible thing. Nobody knows what they own. So one of our biggest things to do is just helping people understand what do you own. And that's what I tell from the participant standpoint out here. Know what you own. Know what it's doing. That way you're not surprised when we have the next big downturn. Not if, when we have it.
Absolutely. All right. Jay, you have anything else? I have one last thing.
No, you go right ahead. I just appreciate so much the knowledge base that these two Chris's are bringing to the table for this topic, and business owners need to be listening to this stuff.
I agree. Chris Bouffard.
Yeah, quick thing. So following up on Chris Roper's point right there on the to versus through, understanding that, knowing to ask and look for that. And then secondarily, for those people wondering, well, how do I understand my exposure? If there's target dates out there that vary as much as Chris alluded to, well, Morningstar after '08 actually did break down their target date categories. Morningstar is a fund rating and tracking company, and they actually broke down the target date population into conservative, moderate, and aggressive target dates based on how much equity they have, just to help the retail client understand the differences between some of the options available out in the marketplace.
Perfect. Chris Roper, anything?
Let's say the last thing that I'd like to add to that would be really just utilize the expertise that's out there to take a deep dive and really look into this. The majority of assets are flowing into target date funds. For most plans that we look at, it's a significant portion of the assets. So make sure you're spending time in your reviews. Take a deep dive and look at these because it's really important, especially when you look at what's the market done the last 10 years. It's gone nothing but pretty much straight up. You can't look at target date funds the same way you look at a large cap value fund because they act differently. So you have the really high equity exposure target date funds over the last 10 years will look amazing, look like, hey, these top funds in their peer groups, this is the best ever. But is the next 10 years going to look like the last 10 years? And I think if you ask the majority of people who really are in the know when it comes to the markets and forecasting, they're going to say no. And Chris knows that better than anybody I know. But I don't know anybody that says that the next 10 years is going to look like the last 10 years. And be forward looking, really be thoughtful about what you have and what you're offering to your people. And maybe they need protection and maybe they don't. Maybe you need to help them out and maybe they don't.
And on that point, don't just look at them at the end point in time right now, trailing backwards, as Chris mentioned. Everything looks pretty good. We're near or at all-time highs on major equity indices, but go back to the fourth quarter of 2018 when we were down 20% on major equity benchmarks, or back to that 2008 period that Chris mentioned, and that'll help you understand the aggressiveness of those target dates.
You know what I'm hearing? I'm hearing maybe it might be a good idea to reach out to your financial advisor. So to have a conversation about some of these things, to bring a team like this to the table. So listeners, if you're listening to this, obviously you're hearing the voice of Josh Knoll with Gulf Coast Financial Advisors. What you're hearing is our team of professionals and experts that can come in. Can't make anything perfect. There's no such thing as perfect in the investing world, but we can apply care, thought, expertise, experience to these solutions and educational pieces, right? Okay. All right. Nothing else? Listeners, if you think these topics apply to you, you can help reach out to us. Call or text 251-327-2124. That's 251-327-2124. Leave a message. Plus, you can visit gulfcoastfa.com or pciawealth.com to hear this podcast and all our other podcasts, and also see our contact info there. While you're there, if you're listening to the show on any of our platforms or on the website, feel free to share it. We're trying to spread the word as best we can, and we need your help. So lastly, I want to thank my two guests today, Chris Roper of Qualified Plan Advisors and Chris Bouffard of Prime Capital Investment Advisors. Y'all did a fantastic job. Thank you for joining us. Again, thanks to my co-host, Jay Stubbs. I've lost my writing here, so I'm going to have to do this from memory. So my thanks. What's your name again?
I'm still here, Josh.
You're still here? Okay. Jay Stubbs. Yeah, that's the voice you hear there. Thanks to our producer, Johnny Gwynn of Deep Fry Studios, and thank you all out there that have been listening and downloading us. We've got some decent numbers coming out of the gate, and it really matters to us, and I check it every 5 minutes, so please do more of it. And this has been Every Dollar Counts with Josh and Jay. Thank you all, and have a great day. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented is for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.